All right, welcome to live stream, everybody. My name is Kyle. Here with me is Dan Frio, and we're licensed loan officers in all 50 states. And what we're going to do today is talk about 3% interest rates and why those likely aren't going to be coming back. And then Dan's going to give us an update on what's happening with rates currently, and then we'll go through your home buying questions. So looks like we might have a chill stream today with not a ton of people, but if you have
We didn't know who would show up today.
but if you have your
Anybody can show up?
any questions, put them in the chat. And basically we go by a first come, first serve basis. So now that there's, basically if you get your question in earlier, it's usually better because by the end, usually people tend to get upset that we skip their question or something, but we can't go through all of them. So also let us know, where are you looking at buying? We'd love to know if you could tell us a state or a city. And then also, what do you think about that market? Are you kind of afraid of how competitive that market's going to be? Do you feel like the market's going to be pretty chill? We'd love to hear that. We have Cal Miner said, "Hi guys from California. Welcome. Are you buying in California? And what city are you looking in? I'm curious. Because California can be a little on the intense side."
Yeah, if you guys would just let us know where you're coming from, even if you're not looking to buy right now or whatever. Just we're trying to cover to make sure we get everybody from like New York to LA, and we're trying to still take. Hey, you're back, buddy. So we're trying to make sure everybody can fill in with this stuff. So thank you so much for everybody joining us again.
Oh, a loan processor in Ventura County. Cool.
Whoa.
I didn't realize. I guess loan processors were watching too.
Cal Miner, are you slow today? Because Kyle and I were talking about it. It was like, we don't know who's going to. Half the people, probably a lot of people aren't working, and then if you are working, it's like, okay, just want to pass the day along. So,
Yeah.
Cal Miner, how busy are you with processing? Love to know.
From New Jersey, looking to buy in New Jersey. Awesome. Hello from Scottsdale, Arizona. That's a little bit of a hot market too, if I'm not mistaken. Phoenix also a little bit of a tough market there. Ken said, "Hey guys from Tampa, Florida, Austin, Texas." Oof, yeah, that's a rough one.
I'd love to talk to him a little more about Austin because I don't know about it. All you hear is all the horror stories saying housing markets crash and there's way too much this. So if you wouldn't mind us, we might ask you some specific questions today if that's okay. Give us a thumbs up if you're cool with that.
Tierra Scott, hello. From Austin, Texas.
Austin, Texas.
Thanks for being here, Tierra, as always. Dan, do you want to cover what's been going on with mortgage rates? There's been a nice little fluctuation back and forth. I think we've been in this up and down thing for the past what is it? Maybe month and a half, somewhere around there.
Here's the strange piece of all this. So we had the presidential debate last week. And since then, I won't really talk about the debate. The next day,
I feel like I lost brain cells watching that debate. I watched
that?
2 minutes. I watched 2 minutes of it. I feel like I lost brain cells.
It's so frustrating, but whatever. What happened was the next day, we had some good reports on the inflation numbers. And the inflation number that came out was the PCE. Now, that's the number one inflation number that the Federal Reserve monitors. It actually came in lower than expected. So my first thought was rates are going to come way down, the markets are going to rally and everything else. And it was kind of the opposite. Mortgage rates didn't move. Actually, they went up a little bit and so forth. So over the weekend, I'm kind of trying to break this down again on Monday. And then we had more information coming out Monday and Tuesday that was good news also on a slowing economy. So when I say good news, I mean, my good news is we're trying to get, affordability back. Okay. So the news that's coming in lately is right in the wheelhouse of the Federal Reserve. And it's really good numbers. We have employment or unemployment going up. Well, normally that's a bad thing, but in this market, it's a good thing. And a whole bunch of other things that came in. And I'm like, well, why are rates going up when all these numbers come in bad? Well, then I really take a deep dive. I start going to, I go into a lot of corporate when corporations have their annual meetings and their sales meetings. So I listened to a lot of that. And the perspective was there that it's the fear of Trump getting elected again, and then a complete wave of Republicans coming into Congress and all this other stuff. So that's the uncertainty right now. Who's going to get the office? A lot of people are afraid that Trump's going to get in, and with the tax cuts and everything else, how that's going to work out and all that stuff. So just today, or the last 2 days, we're starting to see mortgage rates actually coming down, and we might hit 6.99 by the end of the day. But finally, a lot of the numbers are just starting to show really bad things. Like we had the employment report coming in today, dismal. We're starting to see a lot of price action in the servicing sector and everything else coming in way down. So the prices of things are starting to come down. I know you guys might not feel it or see a lot of it, at the grasp of you, but there is things coming down quite a bit. So that's basically what's going on. There's a conundrum right now on Wall Street and everything of who's going to get elected and how's that going to play out in the economy. And that's sometimes trumping all. That's overseeding a lot of the data that we're getting. So tune into my channel every day for 5 minutes to see what the heck's going on and where rates are going. That's the best advice I can give you.
Yeah, I like it. Okay, so what we're going to do here is we're going to go into a little bit of what we heard from the chief economist of the National Association of Realtors and what he was talking about, his opinion on what's going to happen with interest rates. Basically, he's kind of saying that we're never really going to see 3% rates again. So we're going to cover that here in just a second. I do want to mention a couple people who have come in since. Let's see, Cal said, passing the day along, we deal with ISIN programs and bank statements. Full docs are tough to qualify for over here in our area. That makes sense.
Interesting.
Yeah, I imagine it being an expensive area. Where did they say again? Ventura County. Yeah, it's probably a lot of business owners. So you're dealing with a lot of bank statement programs.
That might be a video or a topic we want to cover. Just saying.
Bank statement programs.
The DSCRs. I just did a couple tutorials with other companies that were reviewing, what they're saying and so forth. And they're like, the DSCR is the way to go if you're an investor trying to buy investment properties, especially you can put it in your corporate name with a DSCR program. But we'll talk about that at some other time.
Brett said, watching from Kansas, just sold our Santa Barbara, California house, looking to move from Northern VA in the next several years. Are you one of the dreaded California cash buyers? Is that what's
probably you cash out there
with your equity?
Yeah.
I am curious, Brett. Obviously, you don't say more than you're comfortable with, but from selling your house, do you have a large amount of cash you're able to buy with for a home in Northern VA? Because VA can also be expensive in some areas. So I'm just kind of curious, are you kind of downsizing in price, but maybe having a similar sized house, or maybe, I'm sure you're maybe getting a larger sized land, and kind of what, because I think the fear with people moving from California into other markets is like what happened with Phoenix, is people sold from California, had tons of cash, and then came in to Phoenix, and then were able to purchase with cash or with a huge down payment and have more competitive offers.
Well, the tough thing in the Virginia area, the closer you get to DC, it's nuts. I mean, it is expensive. So just a thought.
With all the news around inventory being high in Florida and Austin, what do you guys think about Austin, Texas?
Kyle, you say this one. That's what I was actually asking him. So here, I'll bring it up because I actually did a report last night. So if you guys watched my video last night, you might not. What I'm trying to do is I'm trying to point out and say, okay, guys, there is still homes in the world or in the country that's affordable. So I'm starting to post a video every Wednesday. I did it actually yesterday because of the week that's going on today is help me find an affordable house. And I did take a look at Austin, Texas. And the data that I got from Altos Research and a lot of other areas, now you might kind of be able to put in your context in here because you live there. I haven't seen a big price crash yet based on all the data, but I know there's tons of building. Like I'll be down there actually in October. There's tons and tons and tons of building. So are people still coming in droves, buying up those houses? Is there bidding wars? A lot of the country, if you have a house 350,000 or less, then that's what you're looking for. There's bidding wars. I mean, but there are specific areas that aren't. So,
Which one was your
you know,
Austin one?
right in the budget friendly dream house. Help me find a house. The one with me
This
and the
one?
thumbs up. Right? Nope. Up
Oh.
with there. So
In
what I
Green
did
Bay?
there. Oh, yeah. Well, that might not be the one. I think I went through a couple other areas. Maybe. I'm not sure.
Maybe
I just
it's
did
one of
one. I
these.
did one yesterday or the day before, but I did go through there. If anybody's here from Austin, what are your boots on the ground looking like? Is there just gobs of properties available? Are they selling? Is there bidding wars? Is houses or neighborhoods just sitting there? That's what we'd like to ask you guys. I'm not, I don't live there. You live there. So if you could help us with this, please let us know.
See, we have Herman, Utah, Murfreesboro, Tennessee. Richie said from Sydney, Troy, Piqua area north of Dayton, crazy market. Most houses are gone within a day. It's interesting. I'm not super familiar with Piqua, but I know Troy's market is rough. I had a friend of mine listed a house. I think it sold within 8 hours, somewhere around there. Crazy market. Most houses are gone within a day. My question is for a $70,000 a year first-time home buyer with roughly $10,000 saved, 700 credit score. Buy now or wait is the golden question.
Here's my take, and then Kyle, you're from kind of that area, so I'll talk in generalities. Here's my thought, and a lot of people are saying, Dan or Kyle, you guys are real estate people, so you're going to always pump FOMO and this and that. I'm not, but here's my take on it. When rates dropped, last October rates hit 8%. By December, they were about 6.5%. We had probably our best January, February in years and years and years. Okay. Then rates creeped up a little again, and our volume kind of trickled down a little bit. My thought is once rates get to, if they get in the mid sixes again or low sixes, we're going to have a free feeding frenzy again. But there's a big but. Where are you? Areas of Florida are tough because you have insurance. We just got an insurance quote for a borrower looking to buy by the end of this month. It was $10,000, $10,000 for insurance. So those areas are going to be tough. But what you're going to have is once those rates come down and if you're looking at a house like 250 or lower, it's a feeding frenzy. And we just had it from the last post that we just showed, what's happening. So if you want to wait for rates to come down and the market to cool a little bit, I think you're going to add yourself to a lot of other buyers. And inventory is coming back right now. So, I think, it might be I think the fall is going to be a good time to buy. You're going to have more choices. Rates are going to be a little bit less than where they are today. And it'll put you in a nice spot versus waiting for everything to transpire and then, having the same. You're going to be back with the masses again, putting bidding wars in on everything and so forth. So that's my take on it.
Yeah, and I also think it's important to keep in mind of like the local markets as well, because I don't know a lot about Piqua, but I do know like Troy and Sydney, those areas are growing a ton, especially Troy. Like Troy's downtown is growing a bunch. The city's putting a ton of money into Troy. You have great school systems. Ton of people are wanting to move into Troy, and so in my opinion, those markets are going to continue to grow, and we're not seeing prices increase or high demand just because there's some like fear of missing out. It's because fundamentally the city is growing tremendously and more people want to move into it. And so that makes it a more attractive area, which usually is going to be more stable long-term because fundamentally the city is growing and becoming more stable and is more attractive to especially a lot of growing families in places like Troy. So paying attention to those local markets I think is really important because a lot of people just kind of cast national data and they're like, this is what it must be, just everyone's overpaying and they don't care about money. And it's like, no, there's reasons why people want to move to certain cities and people are willing to pay premiums to move into those cities because of school systems or because of they're able to be in a nice downtown area or they're close to other things that they want, shopping, restaurants, things like that. Also pay attention to like what businesses are pouring money into some of these cities you're looking to buy in. Because same thing with Troy, tons of like big local chains are moving into Troy because they realize a lot of people are wanting to go into a city like that. So those are the things that I consider are more what's actually happening fundamentally in the cities, and not just trying to think that like a bunch of people have money and they don't care and they have fear of missing out, so they're overpaying for homes.
Yeah.
The people are moving because they want to live in those cities, not because they don't care about the money in their bank account.
Well, that was the video I just did. What I'm going to do every week, I'm going to pull up a city, and I'm actually asking people for comments. That's what it was. Somebody today asked me about Austin, and another one was, I think, Fort Lauderdale. So I'm going to do those in the coming weeks. So I'm going to show people there's a town or a city just north of where I live, and I run a rental analysis. I run an Altos research report on it and look at it, and I show you, would it make sense to buy or rent? Is it much cheaper to rent, or is it equivalent to buy? You might be surprised in a lot of these areas.
Brett said it was an inherited house and will cover about 90% of the VA house. That's awesome. That's a great situation to be in. Tira said there's price cuts in certain parts of Austin, but it's on the outskirts. Tons of buildings on the outskirts. Older homes coming on the market are seeing more reasonable prices than last year. Also, to be honest, to get a good price or a reasonable first home price, you'd have to move to the poor school district areas or boonies of Austin, Lockhart, Gerald, Manor, Elgin, Bastard. Okay, I'm not pronouncing all these.
Here's the funny thing is I have a good friend of mine. His son lives down in the Austin area, and it's a very affluent family. And his son just bought in one of those areas that they mentioned. And my wife was talking to his mother recently, and she was so mad that he bought in that area because she's like, the school districts are terrible. He's like, it's a house I can afford. I know the home's going to appreciate because this area is up and coming. Because Austin, as it builds out, it's going to have to build out in some of those non-attractive areas, and those will regentrify. And those will be, so you don't have to, please don't look at home ownership as like, am I going to be in the money in 6 months? Am I going to be profitable? I could sell my house. It doesn't work that way. You need a long-term plan. It's like when you buy stocks, if you check them daily, you're not getting rich daily. But if you look at your portfolio from last year to this year, hopefully you're up pretty good. If you look back where you were 10 years ago to now, hopefully you're way up. So no, home prices don't go from, here to here in a straight line. But, I can't tell you any market in the whole country that 10 years ago is worth less today than it was then. And if you guys have that, if you can point that out, please post it down below.
Yeah, that's a really good point. I think a lot of people are so worried about these like small short-term things where it's, even if there is a dip, it's like you were mentioning, Dan, it's like over a longer time frame, what you're actually looking at being in a house for. It's not likely that you're going to see those declines, but so many people are focused on these like short-term things. It really is a good analogy that you have of like, if I'm checking my portfolio every single day, Dan gave me the wise advice to hop into the Bitcoin 2X ETF, which still is up, but it's down from what it was. But if I like looked at it every single day, when I look at it and it goes down, I'm panicking. I'm like, oh shit, I got to sell it. But instead, if I don't look at it over time, it's going to continue to go up. And even though it went down, it's still up from what it was, way more than what my S&P 500 ETF is doing. Okay, so we have some other questions lined up here. Let's see, Harit, Noi K, Kat, Tira, Ave L, Kenneth. Okay, so I'm going to get to your questions here in a second. We need to go to what we talked about in the title here. So, Lawrence Young, chief economist of the National Association of Realtors, came out with a video interview kind of talking about what he's expecting with interest rates. And we want to kind of cover a little bit about what he talked about in the video, particularly around a lot of people are expecting that we're going to get back to 3% interest rates. And it's just highly unlikely. Dan and I have talked about that quite a bit on some of these live streams, where a lot of people have this thing going on. And I don't know if it's either because they haven't looked into it or other people have told them this, but they think that we're going to get the Federal Reserve is going to cut rates, and that means rates are going to go down to 3%. And so I'm going to wait on the sidelines till rates lower. That's what a lot of people are saying is, well, I'm going to wait to buy until rates lower. And in their mind, they're thinking, I'm going to wait to buy until rates lower to 3%. Well, the odds of that happening are so insignificant. And we'll explain why. And first, we need to explain, why did rates get to 3% in the first place? Because that is completely out of the norm historically for where interest rates are. So I'm going to go through this, and Dan's going to give kind of a general overview here. So let's first talk about, inventory. Dan, you want to just touch on what's happening with inventory right now before we get into the special circumstance that led to 3% rates?
So here's what you're going to see. Is inventory going up? Absolutely. And is it going up quite a bit from where we were a year or two ago? You betcha. However, here's what you're going to see on all over media. Housing inventory up 5,000% and this and that. What you have to realize is we're coming off the lowest base in history. Okay, so if you have a number that's the lowest number in 40 years and you uptick just a tad, well, that percentage increase is going to be quite a bit. Okay, so please be careful on what you watch when you start looking at this. So can you pull up the inventory stats that we have? I think we have a national inventory, possibly. If not,
no, I wasn't able to get that one.
Okay. So what you're going to see is, and somebody just mentioned Altos Research. I use Altos Research all the time, and I go in there and I try to figure out, what's going on, and it gives you the inventory and so forth. But you can actually go to and look up the inventory on houses, and you can basically pick it by state. Okay. So if you look at, I think that was my video for this morning. So if you look at the inventory, you're going to see in even like the Austin case, it's still not even where it was in 2019. Okay, so when you have a lot of these people coming out saying it's the largest ever in history and it's the worst ever in history, it brings me back to Javier's post or his video on Reventure, the Reventure app. A lot of times they'll give you this data that we have the highest inventory ever in history. Well, based on the charts that they give you that go back 5 years. Well, yeah, you would think that that's accurate. However, if you go back further than that, you'd see inventory levels higher than what we have today. So don't be wowed by the fact that, inventory in Austin or Florida. The first one was, I think it was Tampa or Jacksonville. It had 600% increase in inventory. It's still not at 2019 levels. So that's a little bit of an anomaly, though. Again, in Florida is facing tax issues and insurance issues. And insurance is huge down there. It's increasing exponentially, making it more, harder to afford. But when you start looking at the inventory, yes, inventory's up, but basically from the lowest levels we've ever had in history.
Cool. I'm just starting a little poll here. Okay, so now let's talk about some of the special circumstances that led to 3% interest rates. So before COVID, rates were hovering around that, what would you say, around 4.5%, 5.5% range, somewhere around there for most people. And then we have COVID happens, massive uncertainty happens. You have the federal government's terrified of that the economy is going to stall. Basically, that's what the government doesn't want to happen. They want to see 2% inflation year over year as their target. So they want to see general growth in the U.S. economy. And so when you have a global pandemic that threatens to shut down the economy, the government's going to come in and try to stimulate the economy. So they're pouring tons of money in to make sure that things don't come to a grinding halt. So Dan, do you want to talk about some of the stimulus that we saw with mortgage-backed securities, the 0% rate policy by the Fed as well?
Yep. So here's what happened during COVID. The Federal Reserve dropped rates to basically zero. Okay, there's usually a spread. So it's 0 to 0.5, I think it was. Okay, so that basically made borrowing as cheap as it's ever been before. Here's one area that people kind of dismiss. Okay, during COVID, not only did we have the stimulus packages out to families and everybody else like that, you also had two other things that played a massive role in this. And I did one of my first live videos that I ever did was with a young lady, and we kind of were at odds a little bit on this one, because I said, here's what's happening right now. You have COVID that just hit, but what the government came in and did, they said this: if you have a mortgage that's backed by Fannie Mae and Freddie Mac, you don't have to make a mortgage payment. Okay. And that was for 18 months. Okay. Also, at the same time, the federal government came in and says, if you had a student loan, don't need to pay it. Okay. So on your side of the equation, I'll ask you guys that are watching, if you didn't have a mortgage payment, or you didn't have to pay rent, and you didn't have to pay your student loan debt, what debt would you have? Okay. Is there anything out there? So if you, Kyle, well, let's go back to one other thing. Can you go to the disposable income chart?
Yes.
Here's where my information's validated. Okay. Can you bring that to the 10-year chart, or the maximum? I just want people to understand, here's how this works. What this chart showing right here is how much disposable income people have or had over, well, since 1970 or 1975. You can see right down through there, the chart, it moved up gradually. Every year it'd go up. People were working hard, trying to save money to make a better life for themselves, their families, their kids, everything else. However, when you get up to like 2019 or that area, look at that spike. It's an anomaly. So look at it. When was that? Well, it was between 2020 and 2021. What occurred during that time? COVID. So how did people get the most money in there, and by far double what they usually have? What happened? Well, they got stimulus checks. They didn't have to make a mortgage or rent payment, and they didn't have to make student loan payments. They got a ton of money. So the people were out there buying houses and buying all this stuff. Remember when cryptocurrency that's when also cryptocurrency really got in vogue, and they were selling these EFTs and all this. You could even buy virtual homes and real estate and all this stuff. NFTs. People were buying Peloton, this and that, to keep in shape and all that. We were cooped up and we were going crazy, and we had money to burn, and that's what people were doing. And they sure burned through it. Okay, so that's one piece of the puzzle that we saw. Okay, so now on the other end of the equation, you had the Federal Reserve. If you can pull up the MBS chart. What the Federal Reserve was doing this time, they had the federal funds rate basically at zero. So now how do they manipulate the biggest the biggest debt that people have? How do they kind of get involved with that? It's your home. It's your mortgage. Okay, that's the biggest debt you're ever going to have in your life. So the Federal Reserve came in and said, well, how do we bring these rates to virtually 0.2 to help people, put more money? People that are refinancing, if they have a 6% rate, they can refinance to 2. All that excess money they're going to spend and all this, they're trying to keep the economy stimulated. So what they did is they were buying mortgage-backed security bonds. And here's what you're seeing right on the screen. So every tranche that they did, they would buy $40 to $80 billion worth of bonds. So if you know anything about the bond market, as prices go up, which they're doing right here, they're buying and buying and buying. So if you're buying something in mass and there's only a finite amount of it, well, what happens to the prices? Well, they go up and up and up. And that's what we saw with the Federal Reserve. They were buying mortgage-backed securities, pushing the mortgage bond price to sky-high levels, which what happens when prices go up, rates come down. You had 30-year fixed rates at like 2%. We've never seen it in history. That's what happened. So now what you're seeing right now is the Federal Reserve stopped buying, and now they're letting it deplete off of their I guess, warehouse lines. I'll put it that way. Their assets. So it's coming down. Thank God that they're not dumping like they did back then, because we'd have rates at like 10%. Because what they'd be doing is they'd be flooding the market with more bonds than investors can handle, pushing down the prices, and it would plummet if they dumped all these bonds on the market. It would plummet the prices and rates would skyrocket. So that's what we've seen basically so far of what kind of put us there. So if you can go back to the chart, we can kind of pick up where we need to analyze that to see what points we covered. So we had the COVID lockdown. We had massive stimulus, like he said. Federal Reserve basically took everything down to 0%. People were buying houses because they had all that excess money. People were refinancing. There was people at 4 or 5%. They refinanced at 2.5. It would save them $400 a month. What do they do with that money? Well, they'd spend it.
And one note on this that makes things extra difficult is the majority of people who own a home right now. I need to have this like chart on standby. Let me see if I can pull it up really quickly.
Earlier, I think it just changed recently. I think the average person has like a 6 or 6.5 rate now. Well, because the masses over the last couple of years that were brought in to that equation. But I know what you're talking about. Yeah, that'd be a great chart to pull up.
Let's see. Let's see. Here it is.
I think 65% of people. There it is.
Yeah, this is showing the. Let me zoom out one more time. Okay, one more time to get it all. Oh, man, that's stupid. So this is showing the spread of basically the current homeowners, what interest rates do they have. So everything here in the bright orange is above a 6% interest rate. Light orange is 5 to 6% interest rate. So right here, what is this? This is probably about 95% of people have around at or below a 6% interest rate. So we're currently at 7 right now. So rate and term refinance for a lot of people doesn't make a lot of sense. And then also, Stephen mentioned, why give up a 2.5% rate for a 4% rate? There is no good reason why mathematically, unless you absolutely needed more accessibility in a home or more rooms or whatever, if your current home isn't working out. But that's the lock-in effect that's happening dramatically for a lot of people right now. And that's why we're seeing really tough inventory as there just isn't turnover with homes because people aren't wanting to give up the interest rate that they have. And not only is it not wanting to give up that low rate, but then taking on a rate that's going to be 7.5% is a lot more of a monthly payment than somebody who has, let's say, just above 50% of people have a 4% or below. So then going to almost double that in an interest rate is really a massive change in monthly payment for a lot of people. So it doesn't make sense for a lot of people to sell and then purchase another home.
Cool.
Okay.
Which one do you want to go to now?
You
want to go to current monetary policy?
Yeah, that'd be great.
Okay. Here's what you're going to hear if you watch my videos or even watch CNBC or a lot of the financial channels. They're going to tell you current monetary policy. Is it restrictive, loose? What is it? So here's what you do. Oh, you actually wrote it down. No, you didn't. So here's how they factor it in. And you can watch a lot of the Federal Reserve officials. They come out and they actually say this in this context. They're like, is the rate that we've put out there right now, the 5.5 federal funds rate that we have published, is it restrictive or is it not restrictive? So here's how they look at it. They take the federal funds rate, which today is 5.5. They subtract out the inflation rate. Now, it depends on what you guys want to consider the inflation rate. So let's just say today it's 3.1. Okay. Well, let's just make it simple. Let's make it 3. So if the federal funds rate's 5.5, inflation's 3, that means there's a positive 2.5 there. Well, any positive number when you have that spread is called restrictiveness. So the bigger that number is, the more restrictive the Federal Reserve is. So they're saying right now, we are very restrictive because we're 2.5% over, where policy should put us. So that's why they're saying there's likelihood that we're going to cut rates because inflation is coming down. Now it's getting a little sticky. But now we're starting to also see the employment numbers starting to peter out a little bit. But that's basically what you're seeing right now when you hear the terminology, are we restrictive enough or do we have loose policies? So that's what the Federal Reserve is going to be talking about when they say, is our monetary policy restrictive enough at this time? And it's a positive 2.5. So yes, it is restrictive. Federal interest rate cut potential. You know which chart to bring up. The probability chart with the CME. Oops. So what Kyle's going to bring up right now is the Chicago Mercantile Exchange. They publish this every day. Okay. And I bring this up most of the times. I'll bring it up 2-3 times a week in my videos. So what this chart right here is, let me tell you what the Federal Reserve does. Okay, behind the scenes, they come up and they tell us where interest rates are going to be and so forth. What the CME FedWatch tool is, it's what's the probability that the Federal Reserve will cut interest rates at the next few meetings, and there's all kind of data that goes within this and to figure out these numbers. So right now, it's saying in July there's nothing going to be done. They're not going to cut rates. They're not going to do anything at this meeting, even though some employment numbers came in today really favorable in regards to the economy starting to taper out. Now we have employment numbers also coming out on Friday with a new revised unemployment rate. Now if that ticks to 4.1 or 4.2, you're going to see the markets rally. And it's bad news, but it's good news. Okay, so now what they're saying, this chart's saying is on September 18th of 2024, there's a 66.5% chance the Federal Reserve is going to cut the federal funds rate. And how we know that is because you can see at the top meeting dates and then where the potential rate is. Right now, the federal funds rate is 5.25 to 5.5. So now they're saying there's a probability of 66% that it's going to be cut to 5% to 5.25%. So we watch this. I watch it every day. Last week, that 66% number was actually 53. Just the other day, it was 63, and now we're all the way up to 66. So does this absolute mean the Federal Reserve is going to cut rates? No, but this is all the economists' best guess, especially those at the Chicago Mercantile Exchange who are among the elite of the elite when it comes to the financial markets.
So then now the big 6%. Question is where do you think rates are going to be?
They're going to come down, and this isn't what you guys want to hear. It's going to be data dependent, and when we go out on a limb saying, okay, here's when it's going to happen. I hate coming out saying, how many of those videos you watch saying in 30 days this is absolutely going to be happening? You ever go back after 30 days and see, did it really happen? I don't think anybody ever does. But rates will be coming down. The data is showing it. Inflation's coming down. Jobs numbers reports are getting a little bit worse. Wage growth is starting to taper down. The chart that Kyle just brought up with disposable income, that's kind of petering out. So people are starting to feel that pain that the Fed president, Federal Powell, said, I think it was 2 years ago now or 3 years ago, we're going to inflict pain on businesses and households because we got to jack up interest rates. So that's what they did. So I'm expecting the rates to be about 0.5% lower by the end of the year than they are today, and just kind of stagnant from there. Like I kind of been calling the housing market the last 2 years. I said the housing market is going to be completely flat nationally. You're going to have markets up, 3, 4, 5, 10%. You're going to have markets down 3, 4, 5, 10%. But overall, you're going to have a completely flat market. And then appreciation 5.6 year over year. That's where a lot of the analysts, there's Case-Shiller indexes and all that other stuff telling us what home values are doing. I'll put it this way. I don't really care nationally what home prices are doing. I want you guys to understand, how do you find what your market's doing? Because you shouldn't really give a shit if San Diego's crashing and you're in Dayton, Ohio. Who cares what San Diego's doing? So our goal here is to educate you guys out there on how to determine your market area. So that's our whole goal, truly, behind this. It's not telling you to buy, not telling you to rent. It's not telling you this, just saying, here's how you guys analyze all this stuff. So
awesome.
Sorry, I'm a little passionate about it because I believe I believe in what we're saying. So if you're one of those crash people, God bless you. Just keep renting. I mean, that you don't have to buy. Okay, you don't have to buy. But long-term wealth creation, you're going to need real estate in your portfolio at some point.
Awesome. Let's give Dan give him a little thumbs up here in the chat. Great job, Dan. Let's jump back into some questions here. How do you find out insurance of a potential house? Just like cars, put in info into insurance sites. Yeah, absolutely. So you're shopping for insurance in the same way that you would for a car. So there's a lot of sites that you can get just like a quick quote. If you wanted to do that instead of talking with an insurance agent. But if you want to get a quick quote, you can do something like that. But of course, you're going to need to talk to an insurance company to get a real quote for your home. Yes.
Don't just go online to these things. So when you Google something, the first 3 or 4 things that come up, they're paid advertisements. Okay. Don't click one of those and put in your data, because you're going to get about 400 phone calls from insurance agents. I would highly suggest Google an insurance broker. They're most likely going to find you better prices with the same quality insurance than the big all states and state farms and all that. I can't guarantee that, but please make sure you check with an insurance broker when it comes to that, and bundle, if you have cars and other stuff, bundle it with your package, because you'll get a much better premium for that, or much lower cost for that. And then one last thing, Kyle, what's your deductible on your homeowner's insurance? You have any idea?
I'd
You
I
are
can
like
look it up.
you're the most budgeted person I've ever met in my life, and I find it hard I stumped you. Here, I'll give you guys I'll give you a tidbit out there. When you
Let's
have
see. Let's see.
homeowners insurance, they're going to ask you for what deductible you want, and they're going to want you to be at like $1,000 or $2,500, because that increases the premium. I'm going to tell you right now, you don't want that. I hopefully nothing goes bad on your house, but I would put in at least 5,000 is my deductible. The reason being is, if you have a window broke and it costs you $1,500, or big window or something, like, you don't want to file a claim, because then your premium is going to go out the roof. Another thing is, what I have on my home is I have a home warranty. I always thought they were complete bullshit, but I got one and I use it probably every 3 months on my home, and it's awesome. So I don't know if we have it down here. I'll talk to you at some other point, Kyle, and we can maybe post a link to some of these things down below. But that's what
That
my take
works.
would be on insurance. Sorry, I had 4 cups of coffee today, if you can't tell.
Nice. Let's see. Inventory up in Middle Tennessee, except Nashville, Davidson County. That makes sense. Do you think we're headed towards a renter's market? I guess I don't know what the definition of a renter's market would be necessarily. So that's, without the definition, it'd be kind of hard to define. But are a lot more people turning to renting because homes are unaffordable, or buying a home is difficult for them? Yeah, absolutely. But I don't know what the definition of a renter's market would be. That's kind of been more of a like recent thing that people have kind of made into a phrase. And I'm not saying that it doesn't mean it's not true. It's not like quantifiable to say that we're in a renter's market or a non-renter's market necessarily. So we just try to be careful of like the words people make up and the phrases people make up to push on emotions without having any sort of like data to back it up, is not really helpful for making decisions about if you're going to buy a house or not. So that's why I'm adding that little caveat here. Tiara said, I have teenagers now, so that's why it won't work for me, but no kids or young family, I think it's fantastic. I think Tiara's mentioning Austin, when we were talking about Austin there. What advice would you give to first-time home buyers? Man, that's every single video we do.
Yeah, really. If there was one thing I would, what would be the one thing that you would where people looking for their first house have the least amount of, I guess, knowledge of? What do you think?
I personally think whenever I go to learn something, if I'm completely oblivious to something, I'm like, I want to learn how this works. My method, I know this might be counterintuitive to a lot of people. My goal is to be as overwhelmed as quickly as possible. A lot of people want like a step-by-step, like guide me through the process. But the way our brains work is it's kind of like when you're reading a book, you need the whole chapter summary before you jump into the book. Most of the time people are reading through the chapters and saying, okay, here's what I'm getting myself into. I'm reading the summary, I'm reading reviews. I have an idea of what the book's going to give me. That my brain has context. And that's what I think the same thing with home buying is the best way to do it as well. Is feel comfortable just getting completely overwhelmed. It's not going to make sense for a little bit. And then in a week or two, you're all of a sudden going to feel like, oh, everything is clicking. This absolutely makes sense. And so probably a good jumping off point is on the website here, whenthehouseyoulove.com. If you click start here, I have this timeline that goes through really how the whole home buying process works. And it's long. right? There's a lot of text in here, a lot of resources in here as well. But again, this is where I think just be comfortable jumping into it. I know it's a lot, but your brain's going to be able to wrap around it with a little bit of time. So that's where I would start personally if I wasn't aware of how the whole thing worked.
One of the things I would say is don't disqualify yourself. Okay. A lot of people I think just get to the point. It's like, how many times do you just defer off something? I'll do that later. Or your lease is coming due and there's always an excuse not to buy a house or whatever. Just redo the lease. I haven't found a place yet. Interest rates are too high right now. Oh, my credit score is not good. This and that. But don't disqualify yourself. If you're interested in, trying to find out, would you qualify? How much would you qualify? How's the process work? Reach out to us. We'd love to help you. Kyle, we have if you want to set up a consultation with us, we do that. And this is a service that we offer because, a lot of times you think, okay, I want to, let me see if I can buy a house, and you plug your data into something and you don't know who's calling you back. You might have one of these companies that just has call centers. Those people, they get out of college, they don't probably even know what a mortgage is, and they get into the call center and they're there to help you and so forth. Everybody that you talk to here, there's 3 of us. There's me, Alan, and David. We each have 20 plus years experience doing this, and we want to hear your story. We want to, help you with this. I always tell people I'm a mortgage consultant because I think of a loan officer as just taking the data and doing their thing. I want to help you guys. I've owned probably 10 or 15 homes in my lifetime, and I've done this for over 30 years. I want your story so I can at least help you navigate the environment of what pitfalls that you don't want to go down. I guess that's the best advice I can give you there.
Awesome. Kenneth said, what do you think about new construction homes? What's your biggest tip for someone purchasing new construction? You might want to watch Javier Vidania made a live stream. When was this? 2 days ago? A couple days ago? Yesterday? I don't know. He made a video a day or two ago about new construction and what he's been seeing with clients. Probably the biggest tip is a lot of people think with new construction that they're basically getting they think they're like buying a product from Amazon or something, and you expect it to be new and packaged and never touched and have no issues. But with new construction, just like every home, it needs, you need to have home inspection. Now with existing homes, you're getting that home inspection because usually over time, homes deteriorate a little bit. And so home inspection helps you see what's deteriorated and what are you comfortable with. You don't want to buy a home and then all of a sudden have thousands of dollars worth of repairs. Now with new construction, you're not going to see deterioration because it's new material, it's a new construction. But what the home inspector is going to be there for is for quality assurance. Because what a lot of people have found is that builders' quality assurance isn't always the best. And you really want somebody who only represents you and is only interested in what's best for you to inspect a new construction home and make sure that everything is up to both code and also the standards that you're expecting when you purchase. So Javier's video might be a good one to take a look at. Noi K said Altus Research is great for data purposes, by the way.
It is.
And Jay said, Dan, your comment is 100% true. SoCal here, we purchased our first home for $410,000 in July of 2014. I checked this week now; it's worth $775,000. Oh Jesus! Oh my God! Refi down 3 times from 4.2 to 2.49%. Not bad.
God bless you, man.
That is quite a bit.
So this is a perfect example. Now people say, well, the housing market's going to crash. Look at his house almost doubled in 10 years. Fantastic. So if it takes an 8% haircut, Jay doesn't care. He's still, you ultimately care, but you're way in the money. That's the whole point we're trying to make. Okay, you buy a house now and there's a something happens in the economy and you take a 5% haircut. Okay. Well, you're not going to go out the next day and say, oh, I'm going to sell my house because I'm losing money here. It doesn't work that way. Don't get into a house unless you're going to be there like 5 years or so. Okay. And I can almost assure you, even if you bought today and it dropped, like the housing crash of 2008, if you bought 5, 6, 7 years later, you were equal to or above the price that you paid on that house prior to. So long-term, you'll be okay. Short term, I don't know what's going to happen.
When the Fed decides to cut the rate, most of the buyers will come into the market and home prices go up. With that, is it safe to buy now? That's most likely what's going to happen, because I did a little poll here a while ago, and not a lot of people replied to it. But basically, you're seeing some people who even said, I'm waiting on 4% rates, 3% rates. Those people are going to be waiting on the sidelines for a long time, long time, really, until something catastrophic happens in the economy again, and the government does the same thing that we saw in that chart where it was billions of dollars of purchases for months and months and months on end to get down to that 3% rate. There's a lot of people who are saying, I'm waiting on the sidelines until rates are going to lower. And what I think is going to end up happening is we're going to see interest rates maybe trickle down to the 6% rate, maybe high 5% rate. And then all of a sudden, we're probably going to see a lot more demand happening, kind of that like frenzy happening a little bit. And then I think that's where a lot of people on the sidelines are going to be like, oh, now things are getting scooped up even faster and home prices are going up, or they're more competitive in these areas. And those people are going to say, well, I wish I would have purchased a while ago. And we've had several people on streams over the past couple months who have done the same thing. They were like, I listened to the people who told me to wait years ago. And now I waited on the sidelines expecting things to be different. And now home prices have gone up and interest rates have gone up. And I wish I purchased before.
We should try to do this. We should try to find an equity fund that would help us. And here's what I mean. For those out there that they're saying, I'm going to rent until rates get down to 3 or 4%. We go to the equity fund and say, okay, how about we buy a home for this person? And we put them under contract that they were going to rent from us until rates go to 4%, and then they can buy that house. You think we'd have a lot of renters there forever that would be paying the mortgage for us? Just a thought.
Yeah.
You understand what I'm saying? The people that are waiting for 3% rates before they buy, they're probably never going to buy. I can't say never, ever, ever, but I hope rates never get to 3% again, because that means we're in a catastrophic world event. So if we go in and say, okay, we'll buy the house on your behalf, but you got to rent from us until rates hit 3, heck, they'll be there forever.
Yeah.
You get what I'm saying?
And I will say there was something about the 3% rates that did really make it where I think before COVID happened and we saw these really low interest rates, the thought of purchasing a home was a little bit different. It was much more calculated. It was a lot of people who were more, I want to make sure my budget is good. I want to make sure my down payment is good. I want to really buy a home that's going to be a long-term plan for me. And I want to use this as something that's stable for my family and the goals that I want. And then when 3% rates happened, it all of a sudden became like, I'm just going to buy a house. Because it became really easy. When money's cheap, purchasing becomes really easy and the friction is really low to get into things like that. And so now that we're not seeing that, I think we're getting a lot more back to that world where it isn't as easy to buy a house. And so for the people who weren't going to purchase anyway, in those previous markets, they're not purchasing now either. It's just that when money is super cheap, when debt is super cheap, it makes the barrier to entry extremely low. And so people who probably wouldn't have bought a house otherwise ended up purchasing just because it almost seemed dumb not to, because of how low interest rates were at that time.
Yep.
Johnny said builder incentives, 50K flex cash or 499 fixed rate. It's a really hard one to.
I'd take the 50 grand flex cash. That's me.
Is the flex cash only for incentives, or
I'm assuming it's upgrades. I would finish my basement. That's going to add big value to your home. The after value, 4.99 rate. It also depends on how big the mortgage is. If you're talking $1 million mortgage versus 300,000-400,000 rates, I'm expecting. Let's just assume rates go to 6% within the next 2-3 years that you could refinance. So you'd have to compute your payment from 499 where it is today. Go out 2 years and say, okay, if I could refinance it at 6%, you get where I'm going with the numbers here, because 50,000 is a lot of money.
I'd also be curious what the interest rate is for if you're taking the 50K. What interest rate are you getting there, and then comparing that to the interest savings versus the 4.99. Again, that would be based there's so many factors that go into that, and you'd have to run some calculations to make that happen. But seeing like what's the interest savings over, let's say, a 5 or 10 year period, because that may help you decide whether it makes sense or not to recoup that money.
Cool.
How do you feel about ZipSmart AI? I've never heard of ZipSmart AI. If it's like any other AI company, it's garbage.
Sugarcoat a little bit, would you?
I'm so tired of AI things that usually just sell like
So obviously you don't own
half-baked
NVIDIA.
products. Look, I love AI, but when people just take the teensiest bit of AI into their products and they're like, it's powered by AI, it's like, do you think I'm dumb? I don't know anything about ZipSmart AI, but I'll look into it. Do you expect home prices to continue to climb or level off? This really is a local market to market thing. Altos Research is where we take a look at kind of short to midterm view of where we think home prices are going to go in specific areas. And they do have free reports you can run for different zip codes. What's the significance of paying 20% down for a home rather than paying 5% down? I have a video that I made, what was that, last week or so, that covers that. And the video you'll want to take a look at is, here it is. This one, I know it talks about credit score, but what I'm going to do in here is it actually shows you a couple different strategies with different down payments as well. And so I talk about how you can use the Fannie Mae chart, where is it, to actually show you which is going to be the best down payment to choose, and then different strategies you can use with that. So that's what I'd suggest there.
That's a fancy YouTube channel you got there, Buster.
Kat said, I would say that renter's market is when these institutional investors keep buying bulk starter homes, the $300,000 to $500,000 homes, and I believe it's keeping the home prices right where they are. Yeah, we're definitely seeing that. If that's the definition of a renter's market, yeah.
So that's what I want to get to the point. So just what Kat mentioned there, it looks like it's getting to the point where it's going to be, houses are going to be owned more and more by institutional investors. Do you guys want that? Okay, that's why I'm a proponent of buying my house. Okay, you have a lot of people complaining, saying corporations shouldn't be able to come in and buy all these houses. Corporations shouldn't be able to do this, shouldn't be able to do that, but they are. Okay, you're not going to stop it. Why are they doing it? Because they're making money on it. They're making money on the house appreciation. They're making money on the spread between what they're renting it to you for and what they're paying on their mortgage and a whole bunch of other reasons. Why do you think the institutions are doing that? Now you're going to have other people coming out saying, "Oh, these institutions, they're going to go bankrupt and this and that." Yeah, well, I'll see that, or I'll wait for that when it occurs.
Okay, let's see. Awesome. Yeah. So I pulled up. This is it. I was trying to figure out how to use this, and
Is that the weather? Is that
it does
something?
Yeah, this is the AI thing. Yeah, it's confusing because at first I was like, "Is this a weather site?" Okay, let's see here. Let's take a look at Ohio. I'd be curious to see where they're getting their. Like they don't say anything about their market data and what it's based off of necessarily. Let's see, information. The information button doesn't work. So
Use Altos.
I'm just
That's what I would say.
I'm open to
seriously
new tools, but when I can't see like what data is based off of what algorithms are we using to forecast these things? Why are we forecasting these things? Like things like Altos don't forecast the future, versus it looks like this whole thing is trying to forecast what happens in the future. Altos data is only looking at here's real time and historical data. And then from that, we can gain an idea of what we think might happen in the future. And that's how every, sorry, this is still on here. That's how every single financial instrument works. Is we can't forecast what's going to happen. We can only look at data now. We can look at trends in the past and gain an idea based on what we've seen in the past from that data on what might happen in the future. But nobody knows what's going to happen in the future. In the same way, if I saw I know I'm being hard on this website, but if there was a stock website that tried to forecast what was going to happen with stocks, I just don't think that's very valuable, because who cares if you're trying to forecast what's going to happen? It's not a reliable way to look at data without being completely honest about saying we're only forecasting based off of historic data. Here's what's happened in the past, and here's what may happen in the future. I think is a more honest way and more accurate way to look at what might happen in the future, rather than just saying here's a prediction, just to make us feel good about something. And that's usually what these tools tend to do.
Wonder if you used a system like that and you used it year after year after year, and it was consistently wrong. Would you still use it? Let me know, guys out there. Would you use a system out there that was year after year after year wrong when it comes to predicting values? Give me a thumbs up if you or a thumbs down on that one. And here's what I was meaning by that. You were just saying that on the forecast and so forth. Well, wonder if your financial analyst told you, okay, the stock market's going to crash and everything's going to be worthless. So I want you to sell your house, take that money, all the money you have in the stock market, go rent someplace and put it under a mattress. Okay, they told you that, and they told you year after year after year, markets are bad, this is bad, that's bad, and you just sat there with cash sitting there and you're renting. And then 5 years later, you look back and say, wow, the stock market doubled, house prices doubled, this, that. Would you continue to use that same system? I hope you guys are getting where I'm coming from on this.
I see. I'm on your wavelength. I know what you're talking about.
So that's it for that.
This is not the thing I want. It's this. So what you can do is, if you are ready to take that next step, or if you just have questions about getting pre-qualified, what you can do is go to winthehouseyoulove.com and schedule a call with us. And so what we'll do on the calls, we can answer questions just like we do on this live stream. And we want to figure out what's your scenario. What are you looking to do? And we want to help you be able to see if you can qualify for a loan and get you a pre-qualification letter, so that if you're ready to start shopping for homes, you can go ahead and do that. So from there, we'll have you fill out an application. We can show you your quotes. So we'll help you see what loans you qualify for, what the monthly payment would be, how much you can qualify for as well. That way you have confidence when you go out and shop for a home. You know what your monthly payment is. You're not going to be surprised by upfront costs, and you're going to have an idea of what homes actually fit in your budget, because too many people do the opposite of this. They go and shop for homes and they find this house that they get emotionally invested into, and then they try to qualify for that, and then they find it's at the tip of their budget, and then they may end up making a decision that really puts a lot of stress on them financially. People do it all of the time because they get emotionally connected to the house instead of realistically looking at the numbers first. I know it's not fun to take a look at numbers first, but it really is the best way to do it, so that you don't go through home buying with a ton of anxiety and a ton of stress. And Eccentric said, there it is. Real estate prices are determined by the strength of the economy. Housing prices did not crash in 2008. It didn't bottom until 2011 as inventory contracted. People compare this to 1980s when Volcker increased interest rates, but price to income ratio was very low compared to today. Interesting. Any thoughts, Dan?
No, I agree. I mean, it's based on the strength of the economy. Yeah, I won't even go there. It's these are too hard of answers to come up with. Okay. If you're looking to buy, you need to dissect your local market, your financial strengths, your situation. Don't care what everybody else is doing. Okay, that's basically the bottom line I'm going to put out there. Don't let people tell you that, don't buy because of this or don't buy because of that. If you're in a position and it's what you want to do, but you guys need to put in a long financial goal, tracking system, and figure out how you're going to get from square A to square B. Real estate's just one piece of this. And if you're looking to buy, a home or an investment property, we'd love to help you. That's basically the bottom line that we have here. So we go back and forth with, what's house prices going to do and this and that. Nobody knows. I mean, if Russia starts a war with us, all bets are off. If China joins in Russia and they start bombing the US, all bets are off. We don't know what tomorrow's going to bring. So I do, because I have a crystal ball, but you guys don't. Okay. So listen to everything I say. So that's the easiest way I can say for it. So I got to run. It's a holiday weekend. I'm getting out of here shortly. We'd love to help you guys out. if you're in need of a loan. But Kyle, you end it. You're pretty good at this stuff.
Oh, well, I was say I'll put our emails here. It's hard to type and also talk at the same time. I'll put our emails here in the descriptions. So if you have any questions, any follow-up questions, feel free to shoot us an email, and we'd love to help you out. We'll be doing this again next week, same time, same place. We'll do 3:30 Eastern on Wednesday, and we'd love to see you all there. Thank you for joining.
Happy 4th.